Hello and welcome to Raise Your Average. I'm Pierre Daly. Co-hosting with me today is Adam Butler, CIO at Resolve Asset Management Global. There's a great quote from Fidelity legend Will Danoff. Want to be a contrarian? Then invest for the long term. I love this quote, and reason for that is in 11 words, Danoff sums up the implication and benefit of what it means to be a long-term investor. And it may seem too obvious at first, but perhaps this implies that you should invest in a way that allows for you to have enough space to be able to be a long-term investor. But how do you do that? How do you build a portfolio with allocations you can live with and hold and run for decades, no matter what's happening in markets? A portfolio that allows you to sustain a holding, that you'll feel little need to trade when everything around you is flashing red. And if you weren't in a portfolio like this beforehand, before the likes of the market we're in now, what's the roadmap for transitioning to one that is? Meb Faber, co-founder and CIO at Cambria Investment Management, is joining us from LA. Meb is the manager of Cambria's ETFs and separately managed accounts. Meb is the author of a multitude of books and white papers, a prolific podcaster, a frequent speaker, and has been featured regularly in Barron's, the New York Times, and the New Yorker. So stay tuned. I promise this is going to be a fully loaded conversation. While the music's rolling, hit that subscribe button, like us, and leave us comments.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Meb, awesome to have you back. How's it going?
What up? Great to see everybody. Happy summertime.
How are things in LA?
It's always sunny here. We were just talking about things are good. I'm a little homeless, as I mentioned in the intro. I'm picked the worst time in 20 years to do a little house renovation. So we're living the supply chain dream, but good excuse to travel, get back out in the world. So we've hit up some fun spots, seen some of y'all in the real world recently, which is great, and hopefully back in soon. We'll see. Y'all listeners are welcome to come drop me a line in Manhattan Beach and have a coffee, a beer, or go for a surf when you're here.
I highly recommend taking Meb up on that. Actually, never
Well,
had
I
a
think
bad time.
I think Meb, next time we're in LA, we might maybe physically get together and have record a podcast then.
Let's do it, man. I'm game anytime. Come on down. And once we're back in our house, I'm like not gonna want to go anywhere. So this may be this is the chance.
Thought this would be a really good time to talk about portfolio construction, and you're just like the perfect person to talk about this very subject. We've been having these conversations lately. You weren't with us recently, Adam. We did a whole podcast on the adaptive asset allocation strategy that you guys are running at Resolve. It was terrific. This is like the perfect like part two of that conversation. But you know what? To kick things off, why don't you tell us the story of how you got into the business in the first place, how Cambria Investment Management came to be, and what you're up to these days?
What am I up to these days? I actually spent a lot of time thinking about your intro when you were talking about long-term time horizons, which I feel like everyone says, but no one actually does, right? It's kind of like people say, I'm on this is needling Adam and his crew. I'm on a keto diet, but then you watch them go get the croissant at breakfast or whatnot, right? So like they say it, but then it's do they actually set up systems to behave that way? Which is why we see so many investors fail. Anyway, let's rewind. So yeah, I mean, look, I save a lot of my anger, vitriol, angst for the Robin Hoods of the world, which alludes to what you're just talking about, like how do you set yourself up for success? But I try not to be too judgmental. Look, this was me 20 years ago. I fully participated in the internet bubble. I was an engineering student studying biotech. So it was a dual bubble for those who weren't around back then. So it wasn't just the internet stocks. It was biotech was just as crazy, which has a very similar vibe and feel today, right? Biotech stocks are down like a third this year, probably from the peak 50 maybe. So it's got a similar vibe and feel to that, my favorite bubble, which was the late 90s. But yeah, I mean, I was all intents and purposes ready to do a PhD in grad school in biomedical engineering, and kind of got swayed by the dark side, perhaps. And my year or two off, I mean, I did go to grad school, but my career trajectory, I started working at a biotech mutual fund, and then just kept getting more and more quant, more less and less biotech and life sciences. And one day woke up and my hobby became my career, and vice versa. And here we are. We started Cambria right before the financial crisis, survived it, started launching ETFs in 2013, and here we are now with a dozen funds, and almost a decade under our belt. So we always tell people the best compliment you can give someone in the world of entrepreneurship or investing, or life, really. Look, we're all here another day. Is simply that you survived. So we're happy. Happy to still be around, and particularly these crazy times, last few years, to have made it thus far. That was my 2 minute. How'd I do?
Brilliantly as usual. One of the things I thought we could get into, Meb, trying to sort of think about topics we haven't covered over and over extensively, is how you, right from the start, approached investing with kind of a rules-based bias, right? I mean, you published that quantitative, what was it? Quantitative asset allocation, approach to asset allocation paper in what? Was that 06, 07?
Yeah.
It was a long time ago. And, but I mean, obviously coming out of grad school and working at a biotech fund, I suspect they weren't particularly rules-based in their approach, right? So how did you cotton on to rules-based thinking and begin to move in that direction? What motivated that?
You know, I mean, I talk to like a lot of the younger investors, or on Twitter today too, and I try to say this without the like old person judgment that feels so off-putting, where I'm like, look, many people have lost a ton of money in this last year, and many people have lost all their money in the last year. And there's kind of two paths people take from that. The first path being we blame, the grifters and promoters, or all the bad actors on Wall Street, which have been around for 100 years, by the way. The charlatans and all the bad guys out there, and say, it's their fault. It's my neighbor. I cannot believe he put me in that Dogecoin or that SPAC or whatever, and then I lost all my money. That's a story that's as old as time. What we tell, hopefully it's younger people with not much money. If it's older and more experienced, it's a little harder. You got a family, a bunch of kids to feed, etc. But what we say is like, look, take some pride in it. You may be eating mustard sandwiches for a year, but learn from it, and say, take responsibility. What did I do that was stupid? How do I take these scars and be humble and have the humility to learn from all these experiences? Because again, this was me 22 years ago. I lost all my money. I was trading biotech stocks. I was trading options. And it was like a checklist of like doing dumb things, over concentrated, check, having an investment plan, then not sticking to it, check, like having, a trade idea, then not changing the rules as you went along, check, on and on. And so, even the fund I worked for, which was a sector-based fund, didn't matter if you had relative performance. If you did minus 70 when the index did minus 80, well, good luck. There's nobody around anymore. But it set me down that path of, okay, how can I think rules-based or objectively about what's going on? How can we put this into a process? And, look, that's obviously, like any of us, it's a growth process. Like, it's ongoing 20 years later, and we're still refining it. But certainly that decision to remove, and I had all the biases. I still do. Look, you guys know me. I'm overconfident. You give me all the risks, like I'll take it, like bring it on, baby. And so I need to set up the guardrails. Like if I have vanilla ice cream or mint chocolate chip probably in my freezer, I'm going to eat it. Like that, there's no more certain outcome. So putting in the rules and processes that, help you behave. And diet, I think, is such a great example, but exercise and just life in general, so many things with personal finance, set me on that path. And it's been a long one, and it's ongoing. And it was funny because you mentioned that original paper. I was in my late 20s when I wrote that paper, which is all very popular now today. But at the time, I sent it out to like a dozen people that I really respected in the industry and got like universal F. It's like when the teacher gives you back it's like F circled red. I had one hedge fund manager. We started compiling these, by the way. I have a whole list in Google Sheets that I call Meb Haterade. So anytime someone writes a particularly nasty response to some of my work or something, we smile, laugh, file it away. And this is a long document, by the way, now, listeners. This is many pages. But this first paper, this young, impressionable 20-something wrote it, trying to first attempt at getting out this rules-based process. And one of the most respected hedge fund managers everyone on this podcast know and would recognize wrote back, he's like, this is worthless. Not like, hey man, cool paper, but I disagree with it. He's like, this is worthless. I'm like, worthless? Come on, like at least give me something to work with. But anyway, so it's been a journey like everything in life. But I think for me in particular, the emotional component of money, which we all know is the most important like part of behavioral, like this relationship to money. There's so much built up into it psychologically that if you don't have processes in place, it makes it really, really hard to do a good job of it.
Yeah. So pulling on a couple of threads there. One is, do you think you could have arrived at a more rules-based orientation if it hadn't been for the pain that you endured by taking a more discretionary or freewheeling approach before that?
Like anyone, I tend to think there's like many different paths we all could take in life. I think the easiest way to visualize this is like with life partners, people you've dated, right? Like most of us didn't marry or currently with the first person we met. So there's a whole laundry list of good, bad in between. And for many of us will be in the future as well. And so I like to think that there are many paths that would have been fine. There was a path where, right out of college, I was interviewing with Decode Genetics. Anyone remember this? This was an Icelandic biotech company that was focusing on sequencing the genome of their country, which is very homogenous, right? Iceland is known for being they even have an app if you're dating that lets you know how closely related you are to a person. It's like a Tinder, but for Iceland. But it's unique properties. And I was like, where would I be today? Would I be talking with you good-looking gentlemen, having gone to work in Iceland for a few years? Who knows what I'd be doing? Professional skier. That's what I'd like to be thinking. But who knows? So, I think I was listening to a clip with Eddie Vedder. So I recently saw my first Pearl Jam show. It was on my bucket list. And, they're getting older. But he had a quote, not at the show, but he was talking about his early career. And he said he wished he enjoyed the struggle more, which is easy to say, hard to do, right? Like when you're broke and lost all your money or you have all these trades, like it's easy to be like, yeah, this was great learning experience. Man, I'm so glad I went through this struggle. So I don't know how necessarily like that has guided the path, but I'm certain that it did. Do I think I would have been okay as a venture capitalist in biotech or as a discretionary manager focused on farmland investing? Probably, but like it's the old John Bogle quote. He's like, is this indexing portfolio right for me? Yeah, I think so. Are there better portfolios? Sure. But I can tell you certainly there's infinite that are worse. And so for me, like I've arrived at this sort of rules-based world, which seems to fit the personality, which I think is a big key for a lot of people. Doesn't matter if you're a gold bug, if you're a crypto person, if you're whatever, like find something that aligns with your worldview and psychology is easy to say, but hard to do. But once you get there, I think is the fit that matters.
Yeah, for sure. I think that's after having all these conversations, the last couple of years, since we started, podcasting in earnest. I think I finally realized that behavioral risk is the biggest of all. It's more important to address the behavioral concerns before you do anything else. And so you know what I mean, getting into rules-based investing starts to make a lot more sense once you get over that hurdle of realizing that you're basically your own worst enemy.
And I think what's important on this too is I think there's a lot of investing approaches that are just fine, right? If you look at the Venn diagram, you put one huge circle or list over here of things that are totally fine, and thing on the other side, things that are totally not fine. The list of what's fine is probably long. Like if you had an advisor or an investor that came up to me and said, Meb, here's what I do. I buy 10 high yielding dividend stocks each year. I put them away, and each year I buy 10 more, and that's it. I dollar cost average in them. What do you think about it? And I say, look, that's not for me, nor do I think that's optimal. But if that works for you, God bless you, right? Like, fine. Like, as long as you understand, and this is the problem for most investors, is because they haven't studied history and at least the basics of what has happened in the past, that at least gives you some foundation or anchor from which to have expectations and say, hey, look, this portfolio, he says, look, I recognize this portfolio will decline 50%, maybe once or twice a decade. I recognize in the worst case scenario, this portfolio will go down 80+%. And I'm okay with that. And I've built in things to where, these processes, this money over here, I've paid, I don't have any debt, yada, yada. I'm fine with that. Then that's fine. Is it ideal? Is it what I would do? Hell no. But is it okay? Now there's things where you set yourself up to almost guaranteed fail. As like when the old Forex brokerages had to publish what percentage of customers lost money day trading Forex. It was like 98%. It's like, this is going to be that other scenario. I'm like the Robinhood investors when Vlad's like, the majority of our investors are buy and hold. I'm like, that is a bold-faced lie. There is no scenario where what you just said is true. But anyway, so I think there's plenty that's fine and okay. There's a lot that's not fine and not okay. If you're to ask me for advice or what I think sets people up for a better outcome, I think understanding the narrative and having a story, right, is underappreciated in our world. The best investors, yeah, they're good at investing, whatever, but they tell a good story, or at least make it relatable. But you have to have the understanding of context, Otherwise, that's when, it's the same in relationships. Like, you have expectations and they're not met, like, look out below, right? Like, ready for fireworks. And the same thing in investing is like, so we were saying this about 60-40 this year. One of the worst years ever to begin for 60-40 was down like 12-13%. I said if it closed here today, that's top 5 worst year ever for 60-40 US only. And I polled investors. I said, what do you think the worst drawdown for 60-40 was? And almost everyone says like 10-20%, but it's 50 plus, right? And so those investors will be surprised if that ever happens again. And on top of that, the worst drawdown by definition is always in your future. So it could be worse than that. So there's plenty of ways to do just fine, but I think the struggle comes with investors think A. So last year, the investors that expected 17% returns for the next decade, and then B happens and they get 0. That's when the capitulation, bad behavior, panic, fear all set in.
So how would you, if someone comes and talks to you about their current 60-40 portfolio, which is down on all fronts, and they want to talk to you about, transitioning from that to something that's going to be a little more successful throughout chaotic periods, what's your advice? Like, where do you begin to start to, reconstruct or rejig the portfolio to something that's more to what you would think is your liking?
I think most investors, we now have over 100,000 investors, and talking to them over the years of all stripes. This applies to grandma with their E-Trade account in Texas to institution or family offices all over the world. I think one of the most important things, being relatable and honest, is talking about, everyone gets sold so much, right? They say, oh, you shouldn't do this, you should do Y, and I think being upfront and honest, personally, we talk a lot about this skin in the game, and others don't agree, but I think it's important for managers to invest in their own funds. The average mutual fund manager has zero invest in their own fund. It doesn't have to be close to 100 like mine, but I feel like it should be some. And so, we often have conversations with investors, and I was telling actually our team this last week. I said, many investors that will come talk to us, look, we have 12 funds, so something is always doing terrible, right? That's just the nature of the world. Like, something is doing well, something is doing terrible. And someone will invariably come up to us and say, hey, look, I bought this fund 3 months ago, 6 months ago. It's doing awful. Why shouldn't I sell it? Why shouldn't I do X, Y, Z? And the response they always get from advisors is a long laundry list of like why you should invest in this fund. But to me, often I say, oh, like looking at what's happened, I say, oh no, you don't understand. Like, if you think this is bad performance, this strategy could do way worse. Like, it's only down 10%. Like, this thing could go down 50 or 70, right? And this could underperform its index, not just 1 year, but like 5. So let's have some context, And then we'll talk about it. And the same thing going back to the very beginning of the discussion. And I've said this so many times, so I apologize. You guys have heard this, listeners may not. But people used to ask me, Meb, I'm going to allocate to this fund or strategy. How long should I give it? It's been junk. I'll give it like 3 more months. And I say, no, that's way too soon. You need to give it probably 10 years. And they just blank face, right? Like, what do you, like, you're joking, right? Like, come on, like waiting for me to say, okay, just kidding. But now I would say 20, and like it can show you the stats and the math behind this of these cycles and whatever. So I think having an honest discussion of what can happen and ways to think about the world. So specifically to what you're talking about, if someone came up to me and said, look, I'm 60-40, what's your opinion on this? I say, look, my priors are A, how much you save and invest in the first place is more important than what you invest in. So the fact that you decided to start saving at 50 versus 20 is the biggest decision, or the fact that you just start saving 10% of your income versus 20. Those are going to swamp some of these decisions we're going to talk about later. So assuming you've done those, assuming you have this portfolio, I'm like 60-40 over the next 40 years will probably be fine. Assuming you're not paying 3% for a closet indexer, right? And tax inefficient, all these just basics that people overlook. So structure matters. Not doing stupid selling at the wrong time matters. Once we go through these basic, like, it's like is it lambada? Which is the one you go under and is it limbo?
Limbo.
Lambada is a dance, I think. It's like the bar, like the pole vault, like, right? It's like the bar changes. So like let's jump over these easy hurdles first, and then we'll get to the more important ones. And I'll say, look, okay, well, it's well established, 60-40. All the quants you can talk to will be like, this is one of the worst opportunity sets of our lifetime, if not ever. U.S. stocks are expensive. Bond yields are low. And here we are, with one of the worst starts to 60-40. Finally, now I would have said this a year or two ago too, so caveat. But the basics to me are the main cooking ingredients are, the next one would be, all right, you want to be global. It's totally insane to me to be focused on one country. And this is like the most ratioed I get on Twitter anytime I talk about this, although that mood can and will change. Where I'm saying you shouldn't put all your money in one country, and all the Americans lose their mind about it because U.S. stocks and bonds have done great last 10 years. I say, do you think it's smart why don't you put all your money in UK stocks and bonds or Greek or Russian? And they say, that's crazy. Why would anyone do that? I said, well, you just made the same mistake we just talked about. So going global, to me, is the next step. Is obvious, particularly now where I think foreign and emerging markets are cheaper. To tilting towards value and momentum factors, I think helps you stay out of big crazy bubbles. I think it adds a little return over time. But I think more than anything, it keeps you from the real insanity moonshot ones. Obviously, real assets, which almost no one has exposure to whatsoever outside their own house. So we're talking commodities, real estate, tips to an extent, farmland, if you could get it, are all, I think, in that category. That's just for the basics. This is a long-winded answer, by the way, so sorry. That's the basics of the global portfolio. And then for us, we're a huge non-consensus here, using momentum and trend, call it managed futures, you can call it trend following, call it whatever you want, relative strength, as a nice balance to that traditional portfolio. And the nice thing, like there was an old writer, Paul Merriman, who used to do this, and his was, he did buy and hold and trend, but he would walk through each step and show historically how it impacted return risk numbers for a portfolio, and kind of takes you through the journey from basic 60-40 to this kind of finale. And so you can say historically this is why it's been great, and then of course we're all in a real-time world, but to me that's the journey that kind of gets you to the finish line. And ours is a bit different and non-traditional, but many of the paths, if you stopped along the way, I think would be just fine, including all the priors that we talked about at savings and investing. But if you were to ask me what's the optimal, for me, that's the Trinity idea. And for me, but back to Bogle, if you're going to do just the old buy and hold, it's probably okay too.
One of the things that I've been noticing over the last few years is as a bunch of tools have become available, especially online tools where they already have the data prepared in the background. You can just select funds or indices and they go back a long way. I'm thinking kind of like portfolio visualizer type software. Is you see a lot of do-it-yourselfers who use those tools and they plug in, some of them have optimizers too, which are, can be even more dangerous, but they plug in asset allocations and then they run them back through time, and then they post their W's on, I combined 62% US cap weighted with 8% US small cap value with, 7.2%, blah, 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 blah. And they perceive this as kind of gospel with some, measure of precision. And I keep trying to figure out how to maybe nudge people away from that kind of thinking, right? Like, I don't know, do you come across that a lot? And like, what kind of guidance do you give to people who maybe are over determining that?
I got a good story. My mom, my grandmother, Southern cooks. And by the way, I was thinking today, I was chatting with a friend about sell in May and go away. I said, I have a Southern version of that. It's called sell in May and see y'all in the fall. As summertime, hopefully sabbatical comes around. But I got a good analogy from when I was a kid. We used to make those Toll House chocolate chip cookies and would eat the batter. They never used the recipe. They would just do it by hand, Southern cook, dash of sugar, this much butter, taste it along the way, on. And it invariably ended up fine, delicious. Like how hard is it to muck up chocolate chip cookies, right? Now, if you totally excluded the chocolate chips, it's not going to be as good. If you left out butter or flour, like it's not going to be a good cookie. So one entire category, but the exact percentages doesn't really matter. It's a chocolate chip cookie. It's the sum total of parts. And the analogy we give in the book, our asset allocation book, which I need to update, but this looked at like dozens of famous asset allocation strategies, 60-40, permanent portfolio. And the caveats, these are all buy and hold, market cap weighted. So things you can buy today for roughly zero. Not necessarily then, but today. And we looked at all these portfolios, and the shocking conclusion to me, and they're hugely different. Some had 25% in gold, some had zero. Some had no real asset exposure, some was half. Some put 90% in US stocks. Some had 25%. Two surprising takeaways. One is they all had great performance over time, and there was a fairly tight clustering of compounded returns over, what is this, 50 years since the 70s. However, if you looked at the path, right, they were kind of bounce all over the place. In any given year, best to worst spread was like 30 percentage points, which is why in a short time, people go crazy. They're like, oh my God, like this year, look, commodities, only thing roughly that's up on a buy and hold basis. Everything else is kind of in the tank, right? For the most part, not talking styles like value, just the buy and hold asset allocation. You invest in commodities the past 10 years, that's a different story, right? It's also a different story from 2000, 2008. And so over long periods, simply owning assets that pay you to own them over long periods, you end up in the same place. The path is different. And then the analogy we give in the book is, I was like, if you layer in a ton of buy and hold asset allocation fees, that's actually more important. So we're talking financial advisor, average mutual fund back then, trading costs, whether you do short lending or not, on and on. That's actually way more important than the actual asset allocation for a buy and hold investor, which is a crazy takeaway. And I don't know really anyone else in the world that believes this besides me. And so everyone always gets mad. The Bogleheads are mad at me about this. Everyone gets mad at me. Twitter gets mad at me. I say your asset allocation, if you do buy and hold, doesn't matter that much. Now, it's funny because you mentioned optimizer, because the funny thing is what people include in the initial conditions of their experiment, and it shows their bias, right? And so we've talked about this, but I think it was Goldman, there's an old investing report where it was doing a classic mean variance optimizer. And it's easy to go back in history. Like, we can all do a great back test. I've done millions, right? Like, someone once called me the king of back tests, which was meant to be disparaging, but I took as a compliment. And you can come up with a beautiful asset allocation curve for anything. And the challenge is, how do you create the tolerance bands or restrictions? And so we've talked about this, where you throw in any index of trend following or managed futures, and then you blind the name of the asset classes and strategies, and you just watch how much of a allocation that strategy gets. And it's usually on the far right end of the curve. And Goldman, I forget when they did this strategy optimization, it was like, I think it was over half in trend. And they're like, well, we all know that's crazy, so we can't do that. And you're like, well, what do you mean that's crazy? Like, that's what your experiment just showed, but you don't like the result. I was actually just reading a book on cannabis, and it was talking about, this huge history of cannabis legalization and all the problems it caused over history. And they're like, Nixon commissioned a big medical association study in the 70s. And the study came back and it's like, hey, guess what? Cannabis is not only not harmful, it's actually pretty beneficial. And he's just ignored it, right? And then created 50 years of all the problems that occurred. So it's like these initial conditions and bias we have. And this is true for so many investors, and this is a conversation that we have often with investors. We say, can you honestly be asset class agnostic? And it's really hard for people because they want to be a crypto bull. I'm a crypto bull. You cannot pry these Bitcoins out of my cold, dead hands. Or say I'm a dividend gal or a gold bug. And trying to have the independence of thought to say, look, some of these are good sometimes and some of them are garbage other times. That's just the way it goes. So it goes, as Vonnegut would say. I think that's harder. But again, you guys got to ask me quicker. You got to cut me off after like 2 minutes. Say, Meb, 2-minute answer.
No, but
the
other way I was going with that is that with the proliferation of so many niche products as well, right? Liquid niche ETFs that are theme-based, sector-based, style-based, etc., right? This is where things can get I think when you say it doesn't really matter what asset allocation you adhere to, so long as you adhere to something, those experiments are like big, broad asset classes, right? Like global equities, or maybe US equities, EFI, emerging, global bonds, or US and ex-US bonds, that kind of stuff, right? The big muscle movements. And for most of history, that's really all that investors could have access to on the index side, right? But now with the proliferation of all of these different niche strategies, you've got so much more opportunity for people to misuse and abuse these types of analytical tools, especially optimizers, if you don't really understand, I like your use of the word initial conditions, right? Like any type of strategy that emphasizes duration over the last 40 years is going to look smart, right? If you're going to use just the empirical data to determine your optimal asset allocation, and you've got 40 years of data, it's going to tell you want to own an abundance of long bonds.
I mean,
But we probably shouldn't have the same expectation on long bonds going forward, right?
as you and I both know, the challenges of investors is we love to get enamored with what's working, the hot dot, the hot fund, the hot manager, the hot strategy, and love to run away from what's doing poorly. And the challenge of this, you have this problem now because your RD mix fund is doing great, so you're in the hot seat of good performance. But we talk to investors, and I remember having a conversation with a very large investor once, and they said, we were going through our funds. They go, Meb, tell me, like, what's your best fund? I was like, what does that question even mean? What do you mean, what is my best fund? And he goes, what's been the best? And he goes, look, I'm no noob. I'm not asking you like what's your best performing fund in the last 3 years. Like, that's crazy. He goes, what's your best risk adjusted fund performance in the last 3 years? And I said, to him, and I paused and I said, I know why you're asking me this question. You're asking me this question because you want to avoid that fund, right? And he said, what are you talking about? I said, well, we all know that like once you have a strategy or an asset class, like they go through periods of outperformance and underperformance, and you're not just going to chase the hot one. You want to avoid the hot ones. So you're looking at ones that may be out of favor, right? And it just is this long pause of like, I wasn't trying to shame him, just like, have this moment of thinking, oh, wait, my process is actually just chasing whatever's working. Like, that's crazy. But it's it's easy and seductive, and it feels safe, right? That's like the safest thing in the world. Like, nobody wants to buy a chart of something that's been going down. We did a piece like a year and a half ago. I said, as managers, it's easy for us to always market what's working and talk about how awesome we are. No one on Twitter's ever had a losing trade, right? But the older folks, you guys, I'm putting you in my camp. We have the scars and the humility. We know that, and I take it with pride, like all the mistakes and thousands of losing trades. I mean, my God, to be a trend follower like that, you have to be death by 1,000 cuts. And so I said, look, let's write a different piece, and we let's profile a strategy that has done very poorly, but we still believe in for reasons that are just conditions haven't been favorable. And not do it in a defensive way, like be objective about it. And so we wrote a piece called Totally Not Crushing It, and said, here's a strategy that's been absolutely god awful. And this was a buy and hold multi-factor, so value and momentum US stock strategy. So mostly value though. But it would hedge the portfolio with US futures on the S&P in 25% chunks. Half of that's top-down value, half of it was trend. And so, as you can imagine, leading up to 2020, it had every possible headwind. Growth outperformed value, large cap outperformed small. The choice of hedge was poor, on and on and on. It's just been awful. But I think we appeased the market gods. They're like, bless you, son. You're showing humility. Because as soon as we wrote that fund has been an absolute tear. So now it's going to be like an annual practice where I'm like, what is our stupidest, worst performing, stinky, nauseous-inducing fund strategy, and we got a few that we're going to start to write about. But part of that is, thinking in terms of the beginning of our discussion, like having a policy portfolio, having rules to where you have perspective. Because no one, and you guys can tell me if anyone's ever said this to you, I've had a million people come up to me and say, Meb, your strategy, your fund has been garbage. It's doing worse than expected. We're selling it. We love you. You're a nice guy, but we're selling it. I heard that a million times. You know what I've never heard, and this is verifiably true, is that, hey, Mab, your fund is doing way better than expected. Amazing. So you know what? We're selling it. We're coming back down to target, or we just don't understand why this is doing so well. Right, because they just say, oh my God, you're brilliant. The strategy's amazing. We're going to add more. Right? So if you don't kind of come up with rules around how to think about those situations, and most people don't, they just do the buy decision and wing it. That's where I think you get into a lot of trouble. And all the academic research shows this is not an individual problem. Institutions are equally as horrific at chasing what's working.
Yeah, Lu Zhang and the team that came up with the Q factor model published a database. I think it's 167 different investment strategies, and you can download all of them, daily returns back to the early 60s in many cases. And I thought this was a really good playground to sort of dig around and see whether there's, just looking at performance, whether there's any way to, identify when it might be attractive to switch or emphasize one strategy or one group of strategies over another. And, I must have tried well over 200 or 300 different cuts at this thing, and none of them were any better than just kind of, selecting a random handful of the strategies in all the different categories, right? There's kind of like quality. There's a limited number of ways you can skin the cat, right? There's kind of quality, profitability, value, momentum, maybe, low vol, but there's a handful, maybe a couple more than a handful of different ways you can skin it. Just generally sort of selecting across the different spectrum and just buying and holding them in equal weight was better than any of the different selection methods that I could come up with. But the general lesson being,
right.
Yeah, go ahead.
Well, but the basic, this includes the advice of basic rebalancing, right? But to me, it's the opposite behavior is what you're avoiding, which is, what if you just chase the hot manager after the hot period and then continually switch into those? To me, that is likely, because it doesn't, if you did it systematically, it might be okay, actually. But no one does this systematically. They do it systematically in the opposite direction, where they'll chase somebody who's outperformed, then buy the fund, or wait till someone underperforms and then sell it. Can you take advantage of the opposite of that? I don't know. I think it's really hard. But to do what they do is a guaranteed, in my mind, negative alpha producer. Obviously creates taxes and other problems as well. I think simple rebalancing is probably, the smartest, simple way to keep your mind about you. But it also goes into this whole, why did you buy it in the first place? And
exactly.
We did it was 90% of investors who said, do you establish the sell rules? And they say no. So if you write down, look, hey, here's why I would sell. It doesn't matter if it's a stock, a fund manager, a discretionary investment, a farm, whatever. Why and what are the conditions you will sell this? And think about it, because the way that most people do is they just wing it. They say, let's see how it goes. I don't know. I'm going to buy something. I think there's a bottom in Tesla here. Let's see how it goes. And it's just fraught with peril.
No, I think you want to do, I guess the point is, choose a few things that you think are reasonable and then kind of hold them in equal weight. Or if they're of wildly different risks, then hold them in kind of equal risk weight, right? But trying to get too selective, I think, is a major source of potential error. And then also trying to time the things that you think are going to be effective over the long term is also almost certain to deliver suboptimal outcomes, right?
There's a fun stat.
Figure out what you believe in and diversify.
If you go back 100 years and look at just U.S. stocks and bonds, and let's say, average return for that, whatever, 8% or something, 7%. You said, okay, I'm going to get this exactly wrong. I have perfect foresight, and I'm going to predict which one of these is going to do worse every year and invest in that one. You still make money. You don't make much. It's like 1% or something. But that to me is astonishing, that you could get it exactly wrong every year and you would still make money. And then look, how many people do we know that, do things like, hey, I sold in '09 and never invested again, or I couldn't take it anymore. But I was like, you don't even have to average. You could just muck it up the worst possible way you could muck it up every year and still make money. That to me is amazing. So, but it's, what can you do that's worse is where people get in trouble. Like the I can't take it anymore. I did this. This was on and on. So I think avoiding like this like long tail of worst case scenarios of behaving poorly is to me is really like
Agreed.
the big part of all this.
Well, I think it's, people come by it honestly, right? I mean, if you think about how we're wired behaviorally, we spent the vast majority of our evolutionary existence on the African veldt. If you had a group of a group of people that run and they leap out of the bushes and then they start running, the other direction, you're probably smart. Your instinct is, well, I don't know what they're running from, but if they're running, I should probably run in the same direction, right? And so if you apply that to stock market, it's like, well, this fund has been doing really well the last 2 or 3 years. I should probably run in the same direction. The reality is that the instincts, that sort of the evolutionary behaviors that we've developed in markets mostly just kind of get you into trouble, right? And to Meb's earliest point, a lot of the biggest value of implementing rules is having guardrails against the behaviors that seem so instinctively natural and right, and yet in markets really serve to set you back from where you might have been otherwise if you just behaved in a way that's consistent with some very basic rules.
Well, I liked your point, Meb, that the point that you made earlier, that as long as you've got all the ingredients, it's really hard to screw it up. Even if you don't get the recipe right, as long as all the ingredients are there, you're at least going to get the flavor of it, right? So,
I mean,
what?
look, I think
Okay,
we-
so
I-
so so you could do it. You could obviously do a lot of things worse. Like you've said, there's an infinite number of funds that are worse, infinite number of strategies that are worse. But what are some of the ways that you've come to the conclusion are better way to put these ingredients together?
Yeah. So we did a post in the pandemic called "How I Invest My Money" in 2022. So we go full kimono. And for me, I want to spend almost zero time on my public portfolio. I want it to be set up and just whir in the background, almost like a checking account. I don't want to have to think about it, and let the portfolio make any adjustments that need to be made. And so here's my long list of things that I want in the portfolio. I want exposure to global stocks. I want exposure to global bonds. I want exposure to global real assets. I want tilts towards value. So I'm attracted to value, and we do shareholder yield strategies, partially because I love those sort of like investing 101 strategy, high cash flows, cheap, keeping the CEOs in check with distributing cash to shareholders, on and on. But also because of what it avoids. It avoids the opposite, right? Expensive companies, and think about the last year, how many of these stocks are down 70 to 90% now. And I want to avoid those. And so for me, that works. The value part works. We do some momentum sprinkling in on the equities there. And then with the other half of the portfolio, so that's what we call like the global market portfolio with tilts. On the other half, we do trend following. And there's lots of flavors of that. There's different cousins of whether you do long short, whether you do long flat. And I think really either scenario is okay. And I want those to sort of yin yang. They don't always yin yang. Sometimes they look like each other. Right now, they look extremely different. And buy and hold's tough because you got to hold on and just hope things work out. And usually it hits the fan when everything's going crazy. Trend is tough because often it underperforms when your neighbor's buying, a bunch of high flying SPACs and IPOs and other things too. So, but it's a nice blend, and to me, it checks the behavioral box of not having to be binary all the way in on one investing approach and just hoping it works out. I like the diversification. So for me, like I walk through that, and it works. It works for me. Trinity strategies are up on the year, and so in a world where most aren't, it's doing something a little different, right? I spend a lot of time also investing in private investments. So we come from a farmland background. Farmland traditionally one of the hardest things to allocate to, but it fits in that category of too much work, I think, for most people. So you want some sort of, ideally would be a passive exposure to farmland. I put real estate in that category. It's like my all-time nightmare. Like, why would anyone want to operate and manage real estate? Oh my God. And then I do a lot of angel investing. But to me, I like, with equities, I want to put it in a lockbox and forget about it. 10, 20 years from now, I find out it's been acquired, merged, or it's now a huge company, it's distributing dividends, great. But I want to buy and hold forever on that bucket. So that's kind of what I walk through. We did a post called Journey to 100X that sort of details a lot of the specifics. I'm happy to get into any of them, but that's sort of the one that works for me. And I have a very non-consensus view that most global portfolios and mixed with some cash is actually a much safer investment than cash or short-term government bonds. And we've tried to demonstrate that historically and don't find many people that follow that line of thinking. Maybe Michael Saylor, and he's got a slightly different conclusion than we do. But I think it ends up being a safer portfolio, particularly, and here we are in 2022, where inflation's a lot higher than most would expect.
Given where we are in the cycle, how do you think we can nudge investors into thinking more broadly about diversification, both from into hard assets and then into different styles after US 60/40s treated them so well for the last decade?
You want the realistic, pessimistic view? You'll like this, Adam. I think they'll do it after the fact. I think they'll buy what they wish it bought. Right down the road from me in LA, I think when the gas station goes from, I think I saw $8 in the wild, once that rolls over to 10 and they have to add like a whole nother digit because they don't have a tens digit on the gas station, people will probably get excited about buying commodities and or other real assets. I don't know. I'm hopeful, but eternally frustrated at the timing of people to get it right on the sentiment side. Is any time a good time to become a globally diversified investor? Yes, and do these things. Often, having been through a couple big ones and a couple smaller ones, bear markets, particularly in U.S. stocks, have a way of refocusing people's attention, I think would be the right way to say it, where, investors, you lose some money. And I think it gets I'm in LA, so it's like a earthquake logarithmic scale. Like every 10% down, it gets 10 times worse. So down 10%, whatever. Down 20 is like the inflection point where people, I think, start to wake up and be like, oh crap, this how bad can this get? And then obviously down 30, 40, 50 on and on is gets more traumatic. But I think bear markets have a way of liquidating people's current portfolios. And we say to people, look, listeners of the show, take out a blank piece of paper, write down your ideal portfolio if you had no positions today. It's all right. You clean out your garage. There's nothing in there. What would you put in your garage? It is definitely not what is in there currently. All that garbage in there, you would not go, you know what, I'm going to buy all this again. I really, want to put in these old scooters from the 70s and this old arcade game that doesn't work. I'm going to go buy that on Craigslist. No one would do that. It's crazy. So write down a piece of paper. This is my ideal portfolio. This is my current portfolio. And then realize how much emotional attachment you have to these legacy positions. And so it's a very cathartic, no one will do this, but let's say taxes aren't an issue. Just go sell the whole thing. And then you have this moment of peace where you can say, okay, well, I threw all away all that baggage. Let's begin anew. What would you invest in? And it's never the same as it was, almost never for people, right? They got, I brought this Bristol Myers in the 90s and I don't know, waiting to get back to even, or I own this fund and, they throw a great party, like it just on and on and on, right? But those are emotional decisions, not objective ones. And so I think that process, which most won't do, email me. Let me know if you guys do it, listeners. But
well, what complicates it in this cycle, I think, is just how spectacular the lottery gains have been for U.S. equity cap weighted investors, right? You're operating off 2x, 3x in in the last decade, sort of excluding 2022. And so I wonder if it might take a substantially larger downdraft that persists for longer to give people that kind of pause and potential for review, catharsis and review, just because, people are just so much more wealthy than I think anyone ever dreamed they would be 5 or 6 years ago, due to the fact that indices have compounded at, 3 to 4 times their normal rate over the last decade, especially on a risk-adjusted basis. You think it might take a little bit more pain to get people motivate them to change?
Look, you and I, we've been doing this for a few years now, chatting, and we probably would have said a lot of similar things last year and 2 years ago, but it's different now in 2022. The world has changed, and we said this on Twitter. We're like, this feels like one of these periods where you look around and say, when did all these stocks go down 70 to 90%? And then there's a list, like you can now pull it up on a lot of these companies that are down 70 to 90%. And so it's happened in a tiny corner of the world. You see a lot of our VC friends kind of losing it already, and the rest of the world's like, what, you guys, like, stop being so dramatic.
Yeah.
Like, what's going, and you see some of these
absolutely.
funds that are down 50, 60%, be like, what, when did this just happen? Like, how are you guys down 60% so far this year? And so I think it'll be a process, right? Like GDP, net worth and income in the US relative to GDP was the highest it's ever been, higher than the 20s. And so, you had this period that overshot. Now, my least popular tweet in a long time, and that's saying something, because my tweets are on average very unpopular. And this tweet had no opinions. It just was factual commentary. I said, look, historically speaking, if you look at valuation multiples in the US, this is back when 10-year CAPE ratio we like to use, doesn't really matter, was at 40. It's now at 30, but the same thing still applies. I said, hypothetically speaking, investors don't like paying huge multiples on the stock market when inflation is high. So up to 4%, it doesn't matter. Above 4% is when it starts to kink, and it gets worse over 6%. But historically, investors pay low teen multiples if inflation is where it is today, or even if it goes back down to 6%, even back down at 4%, it's a third lower than it is today from here, not from the peak. And so, man, people were angry about that. They were really up in arms and huffy about that. And I said, I didn't even say anything. I just said this is a historical data fact. And I said, by the way, this isn't sailing through the mean and median. This is just the actual average, which means half or worse, lower than that. And so I think, look, man, it's been, we just did this fun podcast. You heard about Peter Zion, and he's like, look, this has been a great time, and so I translate it to markets. Like, it was an amazing run for the S&P for a decade. Like, my God, like, you had some of the best returns ever. That should give you pause already, right? Everything we know about markets. So, I think it's the exact playbook, like we know what's going to happen. People find religion after the fact, perhaps, but I don't really like, particularly with all the private equity flows. I think it could be a process. I don't think this is a 1 year deal, would be my guess. But remember, my quote, you can put this on my gravestone, as I think it's better to be Rip Van Winkle than Nostradamus, right? Like, just like invest, get this great portfolio, put it on autopilot versus trying to predict. And I'm wading into prediction territory, but my guess is it could be an extended period. It doesn't have to be a decade, it'd be a couple years, but where things don't do 17% a year, and people start to reflect a little bit. Bonds, I think, has been a big surprise for the negative sentiment. I think people assume wrongly that bonds would always hedge stocks, and that's certainly not the case this year.
We've been friends a long time. I've never heard you use that quote, but I love it. I'm totally stealing it now.
Yeah,
better
good.
to be Rip Van Winkle than Nostradamus.
Yeah.
That's awesome.
Yeah.
That's very smart.
I like the point you made. I find like, all the, the more energy we put into making a decision about a particular holding, and when it fails, we're even more unlikely to get out of it because we put so much decision power into it. So when you go to the other extreme of having a rules-based strategy where you had absolutely no part in the decision making, then when your portfolio changes because the rules changed, because the rules determined that your portfolio should change, you have no part in that either, because you have no emotional stock in that. But when you do have emotional stock, I found, like, for me personally, the holdings that I was, most loath to let go, like the stuff in the garage that we hoard, right?
You guys are
You're
gonna have
right.
to
You're
post. You
absolutely
guys are gonna have
right.
to post pictures of your garage after this show, and we can just hold everyone's feet to the fire and say, "All right, guys, this is an episode of Hoarders. We got to take your portfolio. Mine is
And you,
100% completely full currently, so
that's
I
such a
can't
great
talk."
analogy, because that's such a great analogy, Meb, because, it's true. Like, I think most investors, most retail investors anyways, are to a large extent, they're waiting to break even. They're holding stuff that is never going to break even. It's never, might never be fixed for them. But because they made a decision, they liked it at some point. It's almost like they're having to come to terms with shame or humility, and they just can't do it.
Yeah, I mean, there's a lot of emotions wrapped up in money, right? Like you think of, and I think it's probably better now than for our parents and parents' generation before that. Money, very a taboo topic, not just personal finance and investing, if people even talked about investing. I think it's a lot more out in the open now, but still, I bemoan the lack of finance education or personal investing in schools. But it's getting better with y'all's good work and others, right? We're trying, but yeah, it's tough. It's a tough topic. Shouldn't be.
It's
You think about
underappreciated
it.
though how it's a really good point, Pierre, I think, and underappreciated that the more research and due diligence that you do on an investment, the harder it is to let go, and the easier it is to become overconfident and probably overconcentrated in it, right? So there's this tension between wanting to know what you own, but not wanting to know it so well that you want to just concentrate everything in it, and or you're reluctant to let it go if you learn something new about it that makes it not nearly so attractive, right? So, I mean, that's another advantage to rules-based investing, right? You don't fall in love with any of the investments because, you're just following this set of fairly abstract rules, and there's nothing to be emotional about.
Yeah, but that's we say there's two classes of investors, and I'm now pretty heavy in both. Trend following, of course, where it's got a pretty low batting average on average. And we had somebody talking to us on Twitter, and they were talking about a long-term moving average, and they're like, "Meb, how could you use this? Look at this. The last 3 trades have been losers." And I was like, "3? You think that's a lot? I mean, this thing could do 10 in a row losing trades. Like the batting average is not what matters here, right? It's the big, huge winners, the power laws of investing. Like that's all that matters in investing is this power law concept where you have these huge winners. And this applies to market cap indexes too. Like all the gains come from McDonald's and Walmart and Amazon. It doesn't matter if you have an Enron in there. And so one of the beauties of trend following is you learn to live with the losers. Like you get, it's not a big deal. Like you get a little Zen mentality, like, oh, here's another buy signal for wheat. Oh, here's another buy signal for wheat. Oh, here's another buy signal for wheat. Angel investors, it's the same math, right? Like you do 100 investments, half are going to go to zero, and they're totally at peace with that. It's interesting to me though that there's not a lot of overlap between the two camps. I don't know a lot of angel investors that use managed futures or trend, or there's some on the opposite. But I was into a debate with a guy on Twitter, a famous angel investor, Dave McClure, and we were talking. I said, and this is the beginning of the year, and I was like, it's strange to me that not more private equity, but also venture capital, considering how auto-correlated some of their booms and busts are to such very large magnitudes. I said, I'm surprised they A, don't allocate to trend to manage futures, or B, use trend to hedge. It seems like that would be a very obvious psychological, wouldn't take much for them to understand, oh, okay, this would make sense to do that. But I don't know any that do in the traditional sense that way. There's some there's some endowments that will allocate to both, but
Yeah.
I don't know a lot that think that way. But you got to embrace the losers. I love the losers. That's you got to be. We had a post something called like, to be a good investor, you have to be a good loser. You know, we spend most of our time in a drawdown, so it's either all time high or drawdown, and you know you got to be comfortable with both.
Yeah. Well, who said it? You gain something from every trade, either a
Yeah.
profit or
Yeah.
a lesson.
Yeah. Oh man, I just blanked on it. You gain wisdom. I mean, you said it's like listening to a song and someone plays you the wrong song, and then you get that one in your head, and then you can't sing the song or
Yeah.
the melody. It's like you either make money or learn from every trade, but never both. That's not quite it, but it's close.
Yeah. Wisdom or profit, but never both. Something like
Never
that.
both.
Yeah.
Yeah. Failure is a better teacher than success.
Yeah.
Definitely.
What
Well,
else,
should we?
guys? What
should
what
we
do you
let-
No, don't
what
let
do
me
you-
go. I was going to ask what you guys got on your brain. What are you guys working on? Anything particularly interesting in this sell in May and see y'all in the fall summer sabbatical? What's going on this summer? What are you guys working
Wow,
on?
Mike's going to South Africa for a month in July, so he's looking forward to that. Taking the family to Europe in August.
I was going to say,
the first
speaking
time
of
in a couple
running
of
towards
years.
it's running towards the tiger on the savannah. May not see Mike again. He may
Yeah.
not, I don't know if he has the gene, the run away. I think he's the run towards gene.
Yeah, I think you're right. That's a he's a good one to have on safari with you.
Yeah, yeah,
Um,
there you go.
but he's not. It's not healthy for him to go on safari. I
He's a
grant
bigger
you.
meal for the lion. He's a the lion's not gonna be looking at me and be like, oh, like that's just he's a morsel. I want this big lumbering antelope over here. That's what I'm gonna go for.
Yeah, that's right. Tell you what, we've been trying to kick the tires on whether we want to add crypto futures to our risk parity strategy. Because one of the interesting things we've noticed over the last decade is that, well, definitionally, when only a very narrow segment of the market is delivering all the returns, then any attempt at diversification looks silly, right? And
Yep.
I mean, the last decade, 7 or 8 stocks delivered like 90% of total global gains across all markets. And so how do you sort of hedge against these crazy concentrated growth cycles? And, while probably in the next growth cycle, whenever it happens, 10 years from now or whatever, crypto won't be a good hedge for that. But it is an interesting, different bet that you just aren't capturing in any of the other markets that you would typically
What are you
allocate
leaning
to.
towards? Yay or nay?
Well, I mean, because the risk allocation, the capital allocation would be so small because they're so volatile. We're talking about like 1% or less in aggregate to the two contracts. But because they're up like 4,000%, that actually has a meaningful return contribution, even though the risk is a little lower. Now, who knows what will happen going forward. But again, it's just like a different bet.
I like the idea of it. Cam Harvey had a recent paper out on trend following in crypto and had some positive remarks on it. You can add in the show note links. We were hanging out with Professor Dr. Sharp, Nobel laureate, the other night, and someone asked him a question. They're like, Dr. Sharp, does crypto have a role in the global market portfolio? And he kind of paused, and he's like as sharp. He's as smart as a whip as he ever was. And he paused, and he goes, "Yes, but not a positive one." I thought that was so funny. So funny. I was dying, like just trolling everyone in the audience. And he's like, he's like the traditional view of like, hey, this doesn't have cash flows. It's not a a yield producing asset, whatever. But it's as an actual trade diversifier to a traditional portfolio, I don't know why not. I think it's not a huge percentage of the global market portfolio, and because of the volatility, like you said, you can deal with the risk by simply sizing it appropriately. We're getting to the end of the podcast, and now we're getting to the real gems. Portfolio sizing, position sizing, is probably more important than everything we talked about thus far. But if you put me on the resolve board, I'll vote yes. That would be I say, yeah, you guys include it. I think it's a great input. But it's funny, like you talk to all the trend followers, half the time it's like, what's your best returning position? It's like carbon credits, or like wheat's having an amazing year, but for the last 10 years, like which investor has a significant wheat? I mean, and forget about energy in general. Like 2 years ago, we have this conversation, is be like, that's going to zero somehow. But so yeah,
or negative.
Wait, so by the two contracts, you mean Bitcoin and Dogecoin, or Dogecoin and
Yeah,
Shiba,
yeah, right, yeah.
Shiba Inu?
Yeah, just the listed futures. But anyway, yeah, there's always something new to think about. So that's one of the directions we were kicking the tires on. But yeah, there's lots
Awesome.
going on.
So Meb, what do you see? What do you see right now as being the most contrarian thing to do in the market?
I have a whole list on Twitter. I'd love to see Adam do this because I feel like most of his views would fit this category. But I have a whole running list called Meb's contrarian takes on investments that at least 75% of my peers don't agree with. And it's up to about 20 right now. That's not your question, but it's a fun list because it's an equal opportunity offender. There's takes on there that will offend every single person at some point. So restate it. What is the most contrarian investment right now? Is that what you said? Okay. I'm going to tell you one more story because I can't answer a question straightforward. We did a post on Twitter a couple years ago where I said, okay, nominate an investment. Here's a contest, but the game is you have to nominate something that's going to lose the most money over the next year. And the number one and number two investments, you can't make this up, were Bitcoin and GameStop, both of which went up 1,000% in the year that the goal was to lose money, not make money. They went up 1,000%. I'm going to give you one, and this would have been one I would have said last year too, probably, and it's only gotten worse. I think emerging market value, foreign value in general, because now a lot of foreign developed, depending on location, is also pretty beaten down. We bemoan all the U.S. stock valuations, but the reality is foreign developed is totally reasonable and foreign emerging is kind of scorching cheap. Now, that is after, but also before Russia essentially went to zero, and 95% of emerging market funds, including ours, held Russian stocks. Now, what's interesting, and I got to be careful what I say here, so I'm not talking about our fund, but I'm talking about funds in general. To my knowledge, every ETF out there that owned Russian securities has marked those positions to zero. Now, who knows what the future is going to hold? We're ignoring all the obvious death and destruction, the sadness that's going on, just from a purely investment standpoint. Russian people are not their government. Russian companies are not the government, yada, yada, on and on. And you do we have to think in all of our world, quantitative investing, like a probabilistic thinking, right? Here's the possible outcomes. Here's the odds we're giving it. The majority outcome of this scenario is probably, hopefully, and this is, ideal, that this conflict winds down. There's a treaty, new lines are drawn. Maybe the sanctions remain, whatever, but there's a value to those companies, and it may be 20 cents on the dollar, okay? But it's not zero. It can't get worse, right? It can't go worse than zero. There's a small percentage where things go to hell in a handbasket and it is worth zero, but that's already priced in. There's a scenario where, hey, humanity is restored and things just go in the right direction. It's a small percentage, but where not only do those stocks hit par, they hit double or triple par. But all of that is already marked at zero, right? So saying it's a free call option is not quite accurate, but that is one component of this. In addition to the rest of the emerging market portfolio, which is already at huge valuations, huge cheap valuations relative to its history and relative to the U.S. Now, there's a big looming Jupiter of the emerging markets, which is China. And most emerging market funds, if you own it, it's half China, by the way, or some of them it's more. And China, some people think this is a test run like Russia and Ukraine versus China and Taiwan. But China, if you look back at its very short history with valuations in the 2000s, like it's only traded at this valuation twice before. So it's like a 10 PE ratio. It's low for China. And in both times, a year or two hence, was up 50%, and the other time was up 200%. Now, are you getting any sort of premium for investing in Chinese stocks? Like, are you willing to make that bet? That seems pretty anti-contrarian to me right now. China's got to be up there in emerging markets in general. Now, I could talk about the individual countries I love, like Poland and UK. Is at half or 2/3 lower valuations than the U.S. And going back 150 years, those two kind of zig and zag. I got them all day. You guys, we could do this. We used to do a post for a long time, looking at like what is the most beaten down investment, and for many years in a row, it was energy and ag. So if you Google like why you want coal stocks in your stocking for Christmas. It was coal stocks, uranium stocks, and then ags. And I think last year, everything had been going up for a while. So I think it was like Pakistan was like the only thing we could find that was like down 3-4 years in a row or a bunch. Anyway, there's a lot more now today, but I'm going to stick with that. That was my very short-winded answer to your question.
You're not worried about Peter Zion's comments about China going into a demographic collapse this decade?
This is the beauty of being a quant. As I say, I can gossip and drink beers with you guys and talk till the cows come home on investing opinions, and it will not matter one whit to what my portfolios actually do. And as a good example, our largest and oldest fund consistently buys stocks that I would vomit and never in 1,000 years buy if given the discretion. Our largest holding is Dillard's. Dillard's is like, it's like a department store. I don't think I've been in since the 90s. And I'm like, are you gotta be kidding me? This sounds like the worst investment of my lifetime. I want to buy something exciting, disruption, innovation. And we got Dillard's anyway. So that's the beauty of what we're doing. We've actually, most of our value strategies had avoided China for a long time now. Now they held Russia, so a bit of a wash. But I would be surprised. It owns a lot of our emerging market strategy. Actually, has a heavy tech allocation, which is interesting to me because the U.S. and the developed don't. I would be surprised if it didn't in the coming quarters, year, start to allocate more towards China. It makes me nervous as hell, but I'm nervous about anything. It doesn't matter. So. We'll see. We'll see what happens.
What do you think, Pierre? Meb, do you have any? What other ground you want to cover, buddy?
Guys, we could talk for hours. I'm easy, man. It's summertime. It's getting ready to be. I'm ready to wax up the surfboard, come down the Caymans, cruise around on a foil board. We'll see. I need to get up to Canada. I'm ready to travel again. Go some fun places. I got a couple sabbatical projects for the summer that won't happen that I've been trying to do for like the last 4 years. So we'll see when those get some time.
Are we gonna get that Japan ski trip going this year? Or
yen is at 20-year lows, my friend. So not only that, you're getting a big fat discount. This is the time to book it. The yen seems to be about ready to take a big dirt nap. So it's getting cheaper.
I like it. Okay.
Yeah.
All right. Well, thanks, man. Generous as always.
Yeah, Meb, thank you so much. That was I'm at a loss for words because
I am
You've
not.
got
I could talk for an hour more. I'm not. I'm not a loss for words. We could do. We could do this.
no,
This is like
I do this. This is like
part one of
I
the
feel like
trilogy.
absolutely. I feel like the conversation could continue, but if we start a new topic, we're going to be another half hour.
Yeah, easy.
Could be.
All right, guys. It's
But,
been a blast. Blessed to spend the time with you, and thanks for having me.
thank you so much.
Thanks, bud. Good to see you.